Much for tuning in to Talking Point. I'm your host Neeraj Shah. Talking Point undoubtedly are the markets, but the key conversation today with our guest, Mr. Nilesh Shah, would be about how he also analyzed what's happening on the global front with what the Fed did yesterday. But more importantly, in a quarter that is bunched up with events, including the budget, the elections, as well as a fairly volatile earnings season to contend with, and top it all, we have a bunch of global events playing out in terms of the geopolitics as well as the Fed. How does Nilesh train his thinking to figure out what to do in a scenario like this? And he joins us today. Nilesh, great having you. Thanks for joining in. Hope all is safe.
Yes, my pleasure, Neeraj. Yes, all safe, all good. Thank you so much.
So Nilesh, we thought about doing this session as a pre-budget session, but obviously because all that's happening in the market, can I take a few minutes of this conversation at the start to talk something beyond budget, and then we'll get into the budget dynamics as well. First off, just listening to Jerome Powell or reading about what he said yesterday, would you say that the Fed put, which was always there in 2021, is no longer a certainty?
So, Neeraj, clearly we have to look at this in the backdrop of what's really happening with the US economy. And the reality is that the US economy still continues to be very, very strong. In a way, this is how the US Fed has traditionally acted, in the sense that when it requires, it does tend to loosen up. When it requires, it does tend to tighten up. And what this helps is it gives basically a lot of ammunition and dry powder with the US Fed to act accordingly when the situation changes. So the way I look at this is saying is that the damage control has been done in terms of whatever damage was inflicted in 2020. That has essentially been contained. The economy is back. And therefore, it's now time to kind of roll back or unroll a lot of the measures that they have taken. So it has to be viewed only in context of that. The second thing, of course, is inflation targeting, and we know how sensitive the US Fed is to basically inflation. And if you really look at it, US has a unique problem where real estate prices in 2021 are up in double digits. This is like, I would probably think of, this reminds me of our real estate scenario maybe 7-8 years back in India. And we used to always say, look, US real estate prices are so stable. Versus that now, India's real estate prices are stable, and the United States is having to cope with the challenge of surging real estate prices and the spillover effect of that on a broad-based inflation. And that's exactly the kind of challenge or the problem which the US Fed has to contend with. So I probably believe that it's a preparation for the future, and B is to basically, it's also trying to contain the current set of problems which they are faced with. So that's how I would really look at it.
From an equity watcher's perspective, though, therefore, would you believe that, as opposed to a belief that every time something goes wrong, the central bank comes into play and salvages the situation? From an equity market's perspective, 2022 could be different in that they may not be as bothered about salvaging equities as they would be about fighting inflation.
Oh, absolutely. I mean, clearly at this stage when the market indices are at a record high, I don't think that basically the US Fed would be too concerned about how the equity markets are behaving or how they're reacting. This is pretty much a known script that obviously when there are concerns or apprehensions about the US Fed tightening and all of that, markets do tend to react. And obviously, of course, that's based on the fact that cost of capital for enterprises is going to go up, cost of capital for consumers will go up, and cost of capital for investors will go up. That's basically the basic premise. And that's a reality. But on the other hand, equity markets are a slave of earnings. Show me the earnings and I'll show the prices. That's how basically markets tell all participants, okay? So we may, whatever we say that, say technology stocks have corrected and all of that because of the US Fed, but I think it's more about saying from here on, how's the growth outlook and how much of that is already priced in. So my view is that the US Fed probably at this stage is less concerned about equity markets. I think it's more focused about how it deals with the economy, how it deals with the labor environment, how it deals with inflation, and is in a way trying to create a cushion for the future.
Okay, so now I'm trying to juxtapose this with what an Indian market watcher would have to contend with, Nilesh. We have a Fed which is no longer likely as predictable as it was, or maybe predictable on the opposite side. We have rising yields and higher rates, arguably in the next few months, both globally and maybe even locally. And in the first quarter itself, aside of the budget, we have the UP elections to contend with, state elections, but UP in particular to contend with, and the possibility that if the incumbent government doesn't come back to power, then what does it do to the reform process? At least the thought will cross the minds of people. Do you reckon the next 20 days will largely, it would be difficult to be very constructive? I know we don't talk short term, Nilesh. I know we plan for a year or 2 years, etc. But I'm just trying to think tactically. Do you kind of escape the mayhem and sit on the sidelines, or do you believe that this dip that has come out thus far in the Indian markets has brought select prices to good levels or good valuations?
So, Neeraj, the way I would address this is basically in a twofold manner. One is to basically look at Indian markets as an aggregate. And I would probably believe that the journey between now and maybe say till May is going to be a bit volatile. And there are going to be upheavals along the way. And I see this from two or three very local or domestic factors. Like what you rightly said, the budget. Fingers crossed, there shouldn't be anything negative in the budget. The second, of course, is UP election, and I believe that this time around, this is really election. This is really important, obviously, because it will in a way like what you alluded to, saying indicate the government's resolve to be on the path of reforms and path of especially on privatization and disinvestment. The third and the most important is basically how will the March quarter earnings shape up. And why I say this is because you're beginning to see initial pressures, margin pressures in the December quarter. I'm not yet saying it is ubiquitous. I'm not saying this is across the board. But there are indications that margins, and it's like basically a crossover which corporates are trying to do, is adjust their selling prices so that they can absorb margin pressures. Now, if they are able to pass on these margin pressures or higher input costs to consumers, then I think the March quarter numbers should be fine. If they're not able to do that, then the March quarter numbers could be under pressure, and those results you will see between April and May. So that's why I think that there are a bunch of local factors which I think are going to be terribly important between now and May. So I'd probably say that the next 4 months, I think investors will need to tread with caution. Having said that, Neeraj, I've also seen in my long years of experience that there is a continuous rotation. It's not like money moves out en bloc out of the market. There is rotation which goes on. And it's quite possible that sectors or companies where the surprise element is no longer there and there is high ownership will tend to underperform. And capital will gravitate towards basically businesses where there is going to be surprise element in terms of earnings and are relatively under-owned. And that, I think, needs to be the focus of investors. So in a way, there has to be a bit of a wait and watch, but I think it has to be a continuous process where you try and identify stocks or businesses where surprise element is low and ownership is high, and you try and in a way cut positions there or exit and get into basically those businesses where there's going to be positive earning surprise and ownership is relatively less.
Okay, viewers, will save this for the end. But let's, before we get to the budget, one final question, Nilesh. There is also this theory being floated around that while India has seen incessant outflows from the FI side for the last so many months, and January was no different. Not just from a flows perspective, but 2022 could be different in that while 2021 India had to contend with slowing growth and in a resurgent opinion on China, 2022 India could be probably the only beacon of hope in the EM space, which will show terrific growth. And therefore, the global investors will take cognizance of this and India will shine through. Is that a valid argument or you dismiss it?
No, I think it's a perfect argument. It's a perfectly valued argument. Look at it. I mean, globally, everybody comes into equities for growth. Okay, else you're better off being in fixed income and or money lying in the bank. From a very macro perspective, today India is the world's fastest growing large economy. If I were to kind of look at the most recent IMF estimates, which have just come probably 2 or 3 days back, where they have upped India's growth estimate for FY23 to 9% or thereabouts. This to me is quite significant. And in a way, it's a validation of India's long-term potential and what we have done back home in terms of economic reforms over the last few years. So to that extent, and if you look at it, the next other players, which is China or United States, what are the growth rates? I think IMF projects China to grow at sub 5%. I have never seen this kind of a differential between India and China in the last 20 or 25 years. I have never seen this. So if I were to kind of look at that differential, let's assume China is 5%, India is 9%. It's a 400 basis point growth differential. To me, at a global scale, this is quite phenomenal. And it's almost impossible for any constructive global investor to really ignore this number. And that to me is going to define the flow of investments into India.
Got it. Now, Nilesh, can the budget upset the apple cart, or does the government not need to do anything in order to make this continue? I'm just trying to think from a government's perspective. They are coming out of the budget ahead of 5 state elections. Will they be tempted to squeeze in a few things which might be populist in nature from an election perspective, beneficial, but from an economy or an earnings or markets perspective, not so?
Neeraj, for this, I'll probably go back to maybe the 7 or the 8 budgets, I forget the count, of the budgets this government has presented under the first term as well as the second term. And if I really look back, I have never seen basically the government bring in the political bit in the union budgets, in the sense that a particular state election or a state of elections or a set of elections have really not guided the thought process of this government when it comes to presenting the budget. And therefore, I believe that I don't think the government will do anything which will dramatically change things. Look at it, by and large, which are the big elections? I mean, if it's largely, it is Uttar Pradesh, okay? And I don't see anything in this budget which can be done to basically woo the voters in Uttar Pradesh, right? You could, of course, say there could be some tweaks in terms of personal taxation, some exemptions tweaked here and there. There is the earlier tax regime, there's the new tax regime, and they all could be merged and made into one. Now, that any day is probably the right thing to do, okay, from a national point of view. I don't think one should give any political flavor to it. So my view is that I don't think, if I were to look at the track record of this government, it's in a way commendable that they have not mixed politics with economics as far as the budget goes. And to me, that will remain the grain of this budget as well.
Okay. Nilesh, since you brought taxation up, just a quick thought. We were talking to BofA Securities, their strategist on Tuesday, and he made this point about how their math suggests that if they're on the tax front, right, that we already believe, or a lot of opinion around how the wealthy are being taxed quite a bit already. Their math seem to suggest that if there is some more done on that front and some cuts done to the less than $1 million income, or even less than 5 million income, between less than 50 lakh rupees income, if the taxes are slashed, which increases the money in the hands of those consumers, then it doesn't make too much of a dent on the budget, and it might be an acceptable thing. My question is, if such a thing were to happen, or inklings of this were to put forth, would it, and therefore it could take a shape of some bit of capital gains tax, or just income tax purely, or wealth tax, would it disrupt the equity sentiment or no?
It would, Neeraj. It would. That would be a clear negative. And that's because it's not that the concept is bad, okay, or the concept does not have ground. The concept of taxing the rich and all that, I'm not saying is wrong. What I'm only trying to say is that maybe this is not yet the time to do all of this. Okay, do not temper with things right now. I think this is still a time where you have to continue to make India continuously a much better destination for investments. Be this investments coming in from outside of India, be this investments coming in from India, be it encouraging savers to basically keep investing into financial assets like equities. These are things which need to be encouraged. They still need to be incentivized. Because look at the numbers. We still have what? I mean, we don't even have 10 crore demat accounts in a country of 140 crore people. We don't even have 10 crore unique mutual fund accounts in a country again of 140 billion people, 140 crore people. So I clearly believe that the stats do not favor any such move. Number one. Number two, I don't know how much taxes will get collected because of this, but it will signal a very, very wrong kind of a move or an intent. So I do not think that these are some of the things that should be done. If at all, maybe there should be uniformity in the way capital gains is taxed on different asset classes. So if there's a disparity between equities and private equity, I think maybe venture capital, private equity should also, the tax rates out there should be probably lowered and brought in par with equity markets. Second is, I would strongly believe that maybe investments above a period of 3 years or 5 years, to me, exemption on long-term capital gains should be restored. So this is the way I would honestly think about it. The bottom line, Neeraj, is we are still a $2,000 per capita economy. We are a $2.5 trillion economy, but the reality is we are still $2,000 of per capita. These concepts of wealth tax and inheritance tax and all that are good when we get to $50,000 per capita, but not when we are at $2,000. So I think it might sound good from a moral perspective, but I think it would be ill-timed.
Okay. Nilesh, the other question, the other question that I had in mind was how important would it be for the government and the finance minister to recognize the fact that even with LIC scraping through, the disinvestment target is a miss, right? And LIC, whether it happens in the current fiscal or just gets transferred into the next fiscal, is a bit of a hit and miss out there. So in order to do a successful LIC IPO, as well as other divestments that they would want to do in FY23, a vibrant capital markets is a necessity. And therefore, safe to assume that logically there should not be too much of tinkering or any tinkering with anything that upsets the apple cart, so to say.
Oh, absolutely. I mean, honestly, there shouldn't be anything which can be in a way perceived to be basically a step back, or basically which is perceived to be a retrograde or a regressive decision. I clearly believe, again, as I said, is that we need to still make India a hot investment destination. Let me put it this way. When I say hot, I don't mean short-term money coming in and going out. I just think that India should be the most favored nation as an investment destination. That's the way I really look at it. So these are some of the things which should definitely not be done in terms of hiking tax rates and all of that. I clearly believe that IPO of LIC or other disinvestment is not just about capital raising. I think it's more about the mantra of the government, which means that minimal role for the government in running businesses. I think it's more a matter of philosophy. It's a matter of ideology. And if India were to kind of move from that $2,000 to $5,000 or $10,000 per capita, these are some of the steps which will anyway help India's journey towards that destination. So my view is that do not temper with anything. India needs a vibrant capital market to basically support a fast-growing economy. That's the way I would put it rather than that. And the two go hand in hand. A vibrant capital market and a fast-growing economy go hand in hand. And that's essentially, so whatever needs to be done needs to be weighed in context of that desire.
Got it. Last question on budget, Nilesh, and then one final question before we let you go. Last question on budget. What are you watching out for? I mean, You reckon a return back to the glide path and affirmation of the same because of the FY26 targets already set? What else in amongst the high frequency numbers would you be keenly watching out for?
Well, Neeraj, there are 3 or 4 things that I honestly would be watching out for. One is, of course, the balancing between growth orientation and fiscal discipline. That's something which I think, from a very, very macro perspective, that's what I would really watch out. I would not get into the numbers, but in addition to all of that, I clearly believe that the only way India can have a sustained growth rate are basically a more than enough focus on infrastructure, number one. Number two, on social sectors like education and health. Third is internet infrastructure. I mean, how do we ensure that 1.4 billion people in the country have access to internet and data? Because if you don't have that, we've seen even in the pandemic that the not so well off children have not had access to education, while people in cities, etc., have been able to go online and do education. But otherwise, the deprived lot have not had those 1 or 2 years of education from the school, and for them it's a loss. So that's the third big area that I would want to kind of really focus. And fourth is, how do we increase our manufacturing competitiveness? How do we increase our competitiveness in the export kind of world? So I think these are some of the things where I would want to really look forward to the budget. In addition to that, the financial sector, which is way more, which is as important as the manufacturing sector or the infrastructure sector or the social sector. How do essentially we, in a way, encourage manufacturing of various things? If you look at it, the big takeaway of 2021 has been essentially double-digit growth of our exports, and the composition of that exports is changed quite qualitatively. And how do we continue that journey that for the next 10 years, India's exports of manufactured products grow at a rate in excess of 20%? To me, these are really should be the cornerstones of this budget.
Got it. Okay, Nilesh, final question. You made this very valid point of how rotation would happen. Over-owned to under-owned, well-discovered to maybe not as well-discovered, with growth being the cornerstone of both the arguments, I'm sure. So keeping all of that in mind, what are the themes that you reckon are themes that could potentially fall slightly out of favor, everything else moving as per script, versus what are the themes that are maybe under owned or what have you, and therefore could come into favor, which might not be currently in favor?
Right. So clearly, Neeraj, I think what is definitely not going to find favor are essentially growth stocks trading at very, very high valuations. Okay. And this could cut across sectors. This is not just about one sector here or there, but that I think will be a challenge in a way that those stocks which are priced to perfection, I would say, will find it challenge if basically growth does not sustain for an extended period of time. So that's one. Two is, I think technology services as a sector again could be up for some challenge in 2022. Given the kind of ferocious up move that they've had in 21 and the kind of where valuations are, that could clearly be under some kind of vulnerability. I'm not saying that therefore it's as a sector it's like a complete sell, but I think one has to be very careful and cautious and be prepared for some period of underperformance relative to the market. I think sectors which could potentially do well this year are clearly sectors like automobiles. Clearly 21 was not a great year for them, especially from demand, given of course the chip shortages and all of that. 2022 could be the comeback for automobiles, number one. Number two, as I see the initial results pouring in from some of the leading pharma companies, I think it could also be a comeback of India's big pharma in the forthcoming year. I would be surprised if there's some reallocation of capital from technology services to basically the big pharma here as well, if you're betting on defensives or global exposures or export-oriented sectors. And then, of course, sectors like textiles have started to, in a way, buzz meaningfully. And who knows that might start looking like a very surprise growth sector, which has traditionally been a a value or a cyclical kind of a sector, might end up being perceived by investors as a growth kind of a sector. So these are some of the pockets which I think could basically end up being underperformers and outperformers in the year ahead.
Sorry, Nilesh, I'll squeeze in one more because you mentioned textiles. So Kenneth told me an interesting facet in one of the interviews that in his 30 years, he's not seen the textile sector being debt-free, and we're seeing signs of that now, where the sector is debt-free. And there are a lot of global noises which talk about India's resurgence in textiles. Do you reckon that while India has hitherto failed to capture the global share and lost it to Vietnam, Bangladesh, etc., can this be a multi-year growth story? Are the initial signs looking like that? It could well change. Are the initial signs looking promising?
So, Neeraj, if I would put this in a backdrop of that, what has essentially been the bane of India's textile sector? Cost of capital, cost of power, challenges of infrastructure, okay, and of course, cost of labor. You know, if I were to really look at it, in the last 1 year or so, cost of capital has come down, cost of energy has, in a way, at least there's enough availability of power, and input costs have come off. These are two things which have clearly gone in favor. The third thing, of course, is the world wanting to look at an alternative destination. I mean, everybody's in a de-risking mode, saying we can't be dependent on one country called China or Vietnam or Bangladesh. We need to essentially have one more sourcing destination, and therefore clearly India fits the bill because we have significant amount of capacity to manufacture textiles. So these are some of the things which have gone in favor. In addition to that, there has been fair bit of economic diplomacy which has gone into all of this, where India has in a way clamored for, or you could say asked for its fair share from a lot of the developed economies, saying is, why can't we essentially also be a sourcing destination? And if you want access to our markets, we want access to your markets. So I think that kind of stuff has also gone in. So I think it's a combination of all of these factors. It could be geopolitical factors, economic factors, and all of that which have gone in. And I believe that these are all sustained triggers, which could essentially augur well for India's textile sector.
Got it, Nilesh. Sorry for getting into that small micro in a very macro conversation, but just needed that out of the way. But thank you so much. Really appreciate your time today. And hopefully we have a great budget.
Thank you so much. Best wishes.
Thank you so much. And viewers, thanks for tuning in.